David Kelly, just a few moments ago, said we have not been paying enough attention to the economic effect of this virus and the ripple effects through economies. You are arguing that, boy, we need to. How bad is it going to get?
Well, Tyler, I think it's pretty clear that there is now a very distinct possibility of a recession in the U.S. Maybe that's even the base or has to be the base case now. The good news is that if a recession comes, it's likely to be relatively mild, relatively short, because there are no major economic imbalances in the economy. The consumer saving rate is pretty elevated. The problem, though, is that even though it may turn out to be a U-shaped economic trajectory, the U initially looks like an I as the economic indicators sink. Then it starts to look like an L when the economy bottoms, and only when growth bends upwards, it becomes clear that it's a U. So I think we will be going through a period of elevated uncertainty. And again, the bad news in the data still has to show up in the next few weeks and months.
You know, sir, respectfully, you mentioned the health of the consumer. You know, I'd push back and say, consumer debt to GDP is at levels we probably haven't seen. Corporate debt to GDP, same thing. Your reply will be, yeah, but the funding, the levels of funding, the interest rates sort of offset that. But I think this is one thing I say. You can correct me if I'm wrong, and I'm wrong a lot. I think people historically they confuse the health of the consumer with their want to spend. The two are mutually exclusive. I never underestimate the U.S. consumers' want to spend. I'm not certain, though, at this time they should be.
Yeah, that's right. I mean, we live at a time of very high uncertainty. The virus is still spreading, so you would expect consumers to hunker down. And so I think you will see the saving rate go up. Lower oil prices obviously help consumers. Lower gasoline prices help consumers, but they're not going to spend these windfalls in this environment. So that's why I think this could actually become the first services-led recession. Usually recessions are led by housing or by manufacturing, but I think you'll see demand for services declining, and consumers will only, I think, become more confident and start spending if and when it becomes clear that the outbreak is behind us. And again, most experts say this is not going to happen before May at the earliest.
Talk to us about the services sectors that will be most vulnerable or most impacted. I'm not sure that's really a verb, but you know what I'm saying, in the recession scenario that you foresee.
Yeah, well, we're already seeing it in travel. So yes. Airlines are affected. We will see it, and we're starting to see it in the entertainment industry. We will see it in the hospitality industry, hotels, restaurants. These are the areas where I think you will see the biggest fallout.
I'm curious, as a data-driven individual, what your reaction is as you look at what's happening in the economies around the globe. What your reaction is when you hear the leader of the administration say that this is all being overstated by fake news and Democrats who are out to harm him?
Well, I think if you look around the world, if you look at the data, you can already see that we've had a very sharp supply shock, a negative supply shock. It's already showing up in the Chinese PMI. We will see it in the manufacturing data out of Europe, which is very closely linked to the Chinese economy soon. We are already seeing the demand destruction in services. We've seen it in China. We are seeing it in Japan. We are seeing it in Korea. And we are starting to see it in Europe. So I think it's very clear if you look around the world that this is a very sharp downturn. Again, it can be temporary, it can be relatively short because there's nothing wrong with the underlying health of balance sheets, particularly in the consumer sector. But I think this will only arrive in the hard data, particularly here in the US, in the next several weeks and months.